Welcome to today's market analysis for September 29th, 2025. Prepare for a deep dive into the candlestick signals shaping our financial landscape. Today's patterns are painting a picture of uncertainty, opportunity, and potential shifts that could redefine investment strategies. Let's decode the market's message together. The S&P 500 has given us a fascinating signal today, forming a doji candlestick on the daily chart. This classic pattern, resembling a cross or plus sign, tells us that neither bulls nor bears have gained the upper hand. It's a moment of equilibrium, with the opening and closing prices nearly identical despite significant intraday fluctuations. This doji formation is often a harbinger of indecision, potentially setting the stage for a major move in either direction. Zooming out to the broader market, we see the Dow Jones and Nasdaq posting moderate gains, with mixed volume signals. The day's trading has been heavily influenced by fresh economic data and ongoing speculation about interest rates. These factors have created a complex tapestry of sentiment, reflected in the candlestick patterns across various sectors and timeframes. Let's break down the dominant patterns we're seeing. The doji isn't just limited to the S&P 500. It's making appearances across several leading sectors on the daily charts. This widespread indecision is a clear indicator that market participants are reassessing their positions in light of recent developments. However, when we drill down to smaller timeframes, a different story emerges. In the small-cap growth industries, we're noticing an intriguing prevalence of bullish engulfing and hammer formations on the 30-minute and 4-hour charts. These patterns suggest that despite the overall uncertainty, there's latent buying interest in these more agile market segments. The bullish engulfing pattern, characterized by a small bearish candle followed by a larger bullish one that completely engulfs its predecessor, is particularly noteworthy. It's a strong reversal signal that we're seeing crop up in tech and consumer discretionary sectors. If confirmed by higher trading volume in the next sessions, this could indicate a potential upward continuation for these areas. Conversely, we're observing bearish engulfing patterns in large-cap utilities and energy sectors. This formation, the opposite of its bullish counterpart, suggests that sellers are gaining control and could lead to short-term pullbacks. It's especially significant given the extended overvaluation we've been tracking in these sectors. Now, let's dive into some specific sector highlights. The technology sector is showing resilience with bullish hammer formations appearing frequently on the 15-minute charts. This pattern, recognizable by its small body and long lower wick, indicates that sellers drove prices down during the session, but encountered strong buying pressure that pushed prices back up by the close. We've counted 12 such bullish signals in tech today, predominantly in the semiconductor industry among large-cap stocks. The energy sector tells a different tale. Here we're seeing bearish engulfing patterns on the 4-hour charts, particularly in mid-cap oil services companies. 9 bearish counts have been recorded, suggesting that the recent overvaluation in this sector might be due for a correction. Utilities are presenting a mixed picture. The daily charts are showing a combination of doji and engulfing patterns, with a bearish bias. We've noted 10 bearish signals, primarily in large-cap electric utilities. This sector has been overvalued for some time, and these patterns might be the first indication of a potential reversal. In the healthcare sector, bullish engulfing patterns are making a strong showing on the 30-minute charts. 8 bullish counts have been recorded, with small-cap biotech companies leading the charge. This is particularly interesting given that healthcare has been undervalued recently, potentially signaling a value opportunity for alert investors. The consumer discretionary sector is giving us a classic bullish signal with Morningstar patterns forming on the daily charts. This 3-candle reversal pattern, consisting of a large down candle, a small-bodied candle, and a large up candle, has appeared 7 times today, predominantly in mid-cap retail stocks. Like healthcare, this sector has been undervalued, making these bullish signals all the more compelling. Let's take a moment to consider the broader implications of these patterns. The prevalence of doji formations across major indices suggests we're at a critical juncture. The market is pausing, reassessing, and potentially gearing up for a significant move. The direction of that move will likely be determined by how prices behave in the next few sessions. The bullish formations we're seeing in technology and healthcare, coupled with their frequency and the sector's current valuations, paint a picture of resilience and potential growth. On the other hand, the bearish signals in energy and utilities, combined with their overvaluation, suggest these sectors might face some headwinds in the near term. It's crucial to note that candlestick patterns, while powerful indicators, should never be used in isolation. They're most effective when combined with other forms of analysis and confirmed by subsequent price action and volume. As we wrap up today's analysis, let's summarize the key takeaways. The S&P 500's doji formation is the headline act, signaling a moment of equilibrium that could precede a significant move. Small-cap growth industries are showing bullish potential on shorter time frames, while large-cap utilities and energy sectors are flashing warning signs. The technology sector, despite its overvaluation, continues to show strength, particularly in semiconductors. Energy and utilities, also overvalued, are displaying bearish signals that warrant caution. Healthcare and consumer discretionary, both undervalued, are presenting interesting opportunities with their bullish formations. Remember, the market is a complex ecosystem, and today's patterns are just one piece of the puzzle. Always consider the broader context, including fundamental analysis, macroeconomic factors, and your own investment goals and risk tolerance. As we move forward, keep a close eye on how these patterns develop. Will the doji lead to a breakout or a continuation of the current trend? Will the bullish signals in undervalued sectors translate into sustained growth? And will the bearish patterns in overvalued areas result in the corrections they suggest? These are the questions that will shape the market narrative in the coming days and weeks. Stay informed, stay analytical, and most importantly, stay prepared for whatever the market may bring. Thank you so much for watching. I hope this video helped you out. We will see you back here tomorrow. Before you go, please leave a comment, smash that like button, and subscribe and click the bell to be notified when new content is available. The information presented in this report is intended solely for entertainment and informational purposes and does not constitute financial, investment, or trading advice. All opinions, analysis, and statements expressed herein are personal views and are not recommendations to buy, sell, or hold any securities or assets. Market data and any related commentary are provided as is and may not be accurate, complete, or up to date. Neither the author nor the publisher assumes any liability for financial losses, damages, or other consequences resulting from actions taken based on the information contained in this content. Please consult with a qualified financial advisor or conduct your own independent research before making any investment decisions. Investing in financial markets involves risk, including the potential loss of principal. This content is purely for entertainment purposes and should not be relied upon for any financial decisions.